Alright, so the balance sheet tells you your financial condition as of a certain date, usually at the end of a period, and it's comprised of three major accounts: assets, liabilities, and equity. So also in that sense, it's very similar to the accounting equation, which states that assets equal liabilities plus equity. And I've gotten it set up in this form to just kind of give you an idea of how these two sides should balance. On one side you'll have assets, and on the other side you're going to have liabilities and equity, and they should balance essentially. That's why it's called a balance sheet. So within the asset, under the asset section, you're going to have different accounts like cash, supplies, equipment. Under liabilities, you're going to have all the liability accounts like accounts payable, notes payable, and under equity, you're usually going to have the ending balance of your capital, or whatever the balance is of your capital at that time. And we're going to get that from the statement of owner's equity, and I'll show you with an example. So let's start by putting in different accounts under assets. So let's start off with the cash account. So let's just say that our cash balance is 550. Sorry. And I'll show you just a hypothetical example of how I can get this. So say, for example, that we started a business and we invested $500 of cash into that business. Again, this is all about cash, no other account. And then we bought supplies for $50. And then we paid a utility bill for $100. And since the money's going out, I'll just put parentheses around these just to show that they're actually negative numbers. And then let's say that we received revenue, and that revenue was, let's say, $200. So the net result of all this would be 550. So that's sort of an example of where I could get cash from. So it's basically, this is a summary of the cash account, and you're going to apply the same rule for the supplies account. So let's just say that supplies at that point in time were $50, and maybe that meant that we bought $25 of supplies one day and $25 of supplies another day in that period, and that's how we came up with the supply account of $50. Let's say that we had inventory, and I'll just abbreviate that, of 150, and let's say that we had equipment totaling $200. And we'll just call this total assets at the bottom here. And let's say for our liabilities that we had an account payable of 150. And let's say we had a note payable. Usually a note payable is money that you owe to the bank, of $100. So total liabilities in this case were $250. Now this equity number we're going to get from the statement of owner's equity, which is the ending capital, this 700 right here. And these numbers I actually got from the video on the statement of owner's equity, so you can check that out to see how I got all of these, these numbers and where this income number came from as well. So we're going to use this ending capital right here from the statement of owner's equity. So we'll say this is our ending capital at 700. So then this is going to be our total equity plus liability, which is just the 250 plus the 700, which should give us 950. And the total assets, if you add them up, they should also be 950. So in this case, our balance sheet balances, which is ideally what we want. So that's a quick example of a balance sheet. Also where I got the numbers from. So like I said, this was just the cash account, a summary of the cash account, and that 550 is where we got this 550 number right here. And as far as the equity portion of the balance sheet, we used the ending capital number, which we got from the statement of owner's equity.